Hello everyone, this week we will learn about leases. Lease is an important topic in the CPA exam and we will learn the foundational concept to advanced level topics related to leases. First we will learn the classification of leases and how we will define whether a lease is a finance lease or operating lease. Then we will learn both categories of leases, whether finance and operating lease, and we learn the accounting part for both parties, lessee and the leaser. Lease is a contractual agreement between two parties. Who are the parties? The parties are the lessor and the lessee. So this agreement gives the lessee a right to use a specific asset, and that asset is actually owned by the lessor, and lessee gets the right to use the asset for a certain time period. And in return, as the lessee is using the asset, the lessee makes rental payments over the lease term to the lessor. And in real business world, you will see that leases are frequently used by different type of businesses. And as I mentioned earlier, leases could be two types: operating lease or finance lease. Now FASB made it mandatory no matter a lease is a finance or operating lease, lessee must capitalize the lease item. Capitalize means lessee will show that item on their balance sheet as leased assets and liabilities. Now let's see what are the advantages of leasing, and you will see the advantages from both parties, lessee and lessor's perspectives. For the lessee is giving a fixed payment, and these fixed rates are monthly installments. So in that way, it's 100% financing at fixed rates. And it also gives the lessee a protection against obsolescence. Technology changes very frequently. What if a lessee would own the asset or buy the asset, and if it's for a car or an equipment, technology changes, then the lessee would have to sell that and buy a latest one. On the other hand, if he would lease the same asset, say for a specific term, 3 years or 5 years, when a new technology based equipment or car would come, the lessee could easily get a latest technology. So there is no fear of that obsolescence will occur and impact on lessee. And of course, lease terms can be customized based on the lessee's need. For example, it could be for 2 year, 3 year, 5 years. So this is one advantages that lessee gets flexibility. Now, if you think of getting a loan from a bank and buy an asset, and if you think of the cost, you will see that as opposed to getting a loan and buy an asset, the cost for leasing is usually less. Now let's see the advantages from the lessor's perspective. Of course, the lessor is receiving monthly rental payment, and the rental payment that the lessor is receiving, it has two components. One is the rental payment for using the asset, another is the interest component, and both are adding as like revenues and earnings for that lessor. And then lessor can also stimulate the sale of the leased assets at the end of the lease term. That means lessor also receives rental payments, interest revenue, and at the end there is a chance that the lessor could also sell the asset. And lessor usually owns the assets, no matter it's the operating and finance lease, and record depreciation expense, and that gives a tax deductible benefit on lessor's book. And the last advantage that a lessor can enjoy, it's high residual value of that asset. So usually you will see the lease asset term are not very long, 3 years or 5 years. Or if you think of an example of leasing a car, there will be some other restrictions, maybe the limitation of the mileage that you can use. So at the end of the lease term, we usually see that residual value is high. So these are advantages of leasing. Now we will see how we could classify a lease, whether it's a finance lease or an operating lease. And we'll see mostly from a lease's perspective, well, the lease classification test is pretty much same from both parties, leasee or leaser's perspective. If the lease transfers the control of the leased assets to a leasee, then you have to classify that lease as a finance lease. That means the control of the asset is going to a leasee, then you will call it's a finance lease. So in a finance lease, leasee takes the ownership of the asset. Legally, the leaser may retain the ownership, but leasee will consume the substantial portion of the asset over the lease terms. And all other leases that do not meet any of the finance lease test, then we will call them as operating lease. So FASB actually describes these lease test steps. In next slide, we'll see here. So you have to do 5 tests to classify a lease. And if a lease satisfies in one of these 5 tests, then we will call a lease as finance lease. And in real world, you will see that majority of the leases are classified as finance lease. Remember, you just need to meet only one test. And in a lease condition where none of the tests are met, then we will call it as an operating lease. So first test is called the transfer of ownership test. Whether the lease transferred the ownership of the asset to the leasee. If it's yes, then it's a finance lease. If the ownership is not being transferred, then check the next test. Purchase option test. Does the lease grant the leasee an option to purchase the asset at the end of the lease term? And it is also assumable that the purchase of the asset option will be exercised. If there is a purchase option, then it will be classified as a finance lease. Now you will also see that another test which is very widely used is lease term test. So you have to see what is the economic life of the asset and what is the lease term. If you see a major part of the remaining life of the assets is also in the lease term, then we'll call it as a finance lease. Then we will do present value test. You know, the leasee will make some future payment, annual or semi-annual or monthly installments, and there might be some residual value. So if we take all those future payments present value, and if we compare that present value and the fair value at the beginning of the lease term, and if we see the present value is almost equal or substantially a major portion of that, the present fair value of that assets, then it will be classified as a finance lease. And the last test that also is used, alternative use of the asset. So if we see that at the end of the lease term, the asset would have alternate use, then it may not meet the test. But if we see there is no other alternate use, then we will see that the lease classification test is also met and it is a finance lease. For next few slides, we will see some illustrations for all these 5 tests. So let's see an example for test 1. Test 1 is transfer of ownership. Gammon Incorporation leases 1 floor of an office building for 5 years to Win Corporation. At the end of the lease, Win, who is the leasee, vacates the floor. Gammon lessor can then lease the floor to another tenant. Is this a finance lease or an operating lease? Now here you see that there is no transfer of the asset. Leasee needs to vacate the floor, and then the floor or that asset will be leased to another party. So that means it did not meet the transfer of ownership test. So based on test 1, we can call it's an operating lease. Now let's see next test. Test 2, purchase option test. Bread delivery service leases a Honda Accord for $499 per month for 40 months with an option to purchase that car for $1,000 at the end of the lease term. The estimated fair value of the Honda Accord is $10,000 at the end of the 40 months. Now you see there is a purchase option. The leasee, Brett Delivery, can purchase the car. Now you will also see whether the purchase is reasonable and whether there is any bargain purchase options. Yes, based on this purchase price at the end of 40 months, which is only $1,000, whereas the fair value of the car will be at the end of 40 months will be $10,000, it's very reasonable that the leasee will take this option. And we also call it's a bargain purchase option. Since it's very reasonable and there is a purchase option and it's very reasonable that the leasee will exercise this option. So this example says that the purchase option test is met and we will call this lease as a finance lease. Then test 3 is about the lease term. Well, FASB says that we need to apply our judgment whether we will define a lease and when we will consider the lease term test, and it's kind of principle based, we'd say, but still there is a threshold and the textbook uses this threshold for many exercises. So the threshold is that if the lease term is 75% or greater than the economic life of the leased assets, then we'll say, okay, yes, it met the lease term test. And you'll also remember lease term is fixed and non-cancelable, and there might be an option to extend the lease term. It's also known as bargain renewal option. So if you have this type of bargain renewal option, we also will need to consider, and we also need to check whether this renewal option is reasonably certain. Now we will see one example of lease term test. In this example, Home Depot leases Dell PCs for 2 years and the rental payment or lease installment per month is $100. And there is another option. Home Depot can lease these computers for $10 per month for another 2 years. So now based on this information, how you will define the lease term? So at the beginning, it's clear that initial term is for 2 years. Now, if you look at that, the lease rental payment for the first 2 years is $100, and then Home Depot has the option to extend it for another 2 years only for 10 months. So this is called that bargain renewal option, and it is very certain based on these numbers that Home Depot is more likely to extend the lease term. So when you have to figure out the lease term, it's not 2 years, since it's very certain and reasonable that the lease will be renewed based on the concept of bargain renewal option. We will say that the lease term of these computers are for 4 years. And now when you have to do the lease classification test, you have to check the life of those computers, and based on that, whether based on these 4-year terms, we will do 75% test. Then here, test 4 is talking about the present value test. So present value of all future lease payments, if it exceeds 90% of the fair value at the beginning of the lease term, then we will classify this lease as a finance lease. So again, this is a threshold. You will remember for present value test, it should be the present value of all future payments should be 90% or more than the fair value at the beginning of the asset, and for a lease term test, it should be 75% or more of the entire economic life of the asset. Now, what do you mean by lease payments? Of course, it's the fixed payments. It could be monthly payments, monthly installments, or yearly installments. Then it could be also variable payments. So variable payments are tied to certain other items. For example, how much the lease payment will be can be based on stock market index or consumer price index. So these payments are not fixed in that way, so it's called variable payment. Now, guaranteed residual value. So at the end of the lease term, the asset would have some value. We call the residual value. Now, this residual value could be guaranteed, or there might be unguaranteed residual value. When Lease does the test, Lease consider only guaranteed residual value. Now, any other payments related to the purchase or termination options that the lease is reasonably certain to exercise. So when we will calculate the lease payments, we will take all these and we will calculate the present value, and then we'll compare whether it is 90% or more than the fair value of the asset at the beginning of the lease term. We will see some lease payment examples. It's the basic lease payment concept. So there is a fixed payment or variable payment, and later in comprehensive problems for operating and finance lease, we will discuss how to calculate the present value. So in this problem, on January 1st, Jose Company leases an airplane for 6 years. The lease payments are $1 million per year, payable at the beginning of each year. In addition, the lease payment increases by $30,000 every year. What are the lease payments for 2026 and 2027? So they make the payment at the beginning of the year, and the first payment is made on January 1st, 2025, which is $1 million. Second payment will be at the beginning of 2026, but you know that this is increasing by $30,000, so 2026 payment will be $1,030,000. For next year, which is 2027, the payment will increase by another $30,000, and this is $1,060,000. So now you see that apparently every year's lease payments are not the same. So the question is whether we will call it as variable payment or fixed payment. We will actually call it fixed payment, although the payment amounts are not the same, but you actually can determine it will increase by $30,000 every year. So in that case, the incremental part is fixed. Now, for the next example, you will see that the same company, they're leasing an airplane for 6 years, but each year after the first payment, each year's payment will be increased by a change in the consumer price index or CPI. So we don't know what will be next year's increment in CPI. So they say that here the consumer price index, if we see the basis is 100 at January 1st, 2025, it increased to 104. That means 4% increase in CPI for the next year. The question is, what is the second payment or January 1st, 2026? So it will be 4% increase. So you have to multiply it by 1.04. And the following year, we don't know yet what will be the CPI changes. So it could increase, decrease, increase at a higher or lower number. So in that scenario, we will call this is a variable payment. Illustration number 3 is also about lease payments. Cabrera Company leases a building and land from Worldwide Leasing for 6 years with a monthly payment of $10,000. The lease contract allows Cabrera to terminate the lease after 2 years for a total payment of $140,000. Now, at the start of the lease, it is reasonably certain that the lease will not continue the lease beyond 2 years. So what are the lease payments? So we need to know the lease payments, whether it's a variable or it's fixed, and we need to calculate the present value of the lease payments. And here we will see that it is very certain that the lease will be terminated after 2 years, although the lease is for 6 years. So the question is, what is the lease payment? So now, since it's certain that the lease will be terminated, and if the lessee needs to calculate the total lease payments to know the present value of this lease amount or lease liabilities, so we will of course consider 2 years $10,000 monthly payment, which means for 2 years 24 months, 24 times 10,000, and then it's also certain that lease will be terminated. And if the lease will be terminated at the end of 2 years, lessee needs to pay $140,000, and we will also include that term when we we will calculate the total lease amount. So this is 380,000 is the total lease payments from this example. And then you will see here alternate use test. So this is the last test to classify and check whether a lease is a finance lease or operating lease. So for that asset, if we see that at the end of the lease term, the leaser or the original owner of the asset does not have any alternative use, then we'll say, okay, this lease contract actually met the alternate use test and it will be a finance lease. That means if there is no alternate use of that asset at the end of the term, we will consider it as a finance lease. And we assume that leasee actually uses all benefits from the leased assets. So let's see this example. Hale Construction builds and leases hydraulic lifts to meet unique loading dock configurations of Amazon. So now if we see there is a lease agreement between Hale Construction and Amazon, and the lift is specifically made for the use of this company Amazon, whether we will say that the lease test met alternate use test. So now the question is whether there is any alternate use of the lift at the end of the lease term. Actually, no, because this lift is built or constructed to meet unique loading configurations for these leasee. So it does not have any alternate use after the lease term. So that means the alternate use test answer is yes. It met the alternate use test options, and then we will call it finance lease. Remember, if there is no alternate use, we'll call that it met the test. Then we will see one comprehensive problem. It's pretty much what we learned so far. So I separately posted the comprehensive problem. Please read it. It's in a separate folder, also in your Blackboard.